Hey, good morning. It's Tuesday. It's time for the Red Shoe Business Club to be on the air, and I hope you're with me this morning. This really will be short because what I'm going to talk about today is the ultimate in tax geekiness, but it's important to talk about, even if only for a few minutes. I'm Mike Wright with Taxwright. We're the sponsors of the Red Shoe Business Club. And as you can see, I'm talking from my desk again today because the only thing I'm going to share with you is a little piece out of an article from the Journal of Tax Practice. And we're talking about the Internal Revenue Code. So let me provide you with a little bit of background. I mentioned last week that the projected publication date is still November 1st. My book entitled S Corp Revolution will be out. Many of you know, and those of you that don't know will find out, that the big push that I make with the small businesses that I work with is to see to it that they are S Corps, that they're organized as S Corps. That stands for Small Business Corporation. But there are tax advantages to S Corps that are uniquely beneficial to small businesses like the ones that you and I run, and that's why I encourage people to use this. But the focus of everything that I say about S Corps has to do with the tax savings that you realize. Well, one of the concerns that the IRS always has is whether or not a scheme that's put together for the purpose of saving taxes is actually a legitimate method of reducing taxes, or whether it's a scam, whether it's an attempt to evade taxes, whether it's an attempt to do something illegal. I understand their point of view because they are charged by Congress with the requirement to collect tax revenue for the federal government. Well, up until the last 4 or 5 years, this doctrine of economic substance was simply something that was done by understanding. It was not put into the law. It was not codified. And you may remember when we talked yesterday about the definition of a business, there were only 4 or 5 different rules that were listed, and even each of those had some kind of escape valve, if you will, or they weren't specific, this much but not that much, and so forth. Well, the doctrine of economic substance was handled in much the same way, but now the law has been changed, and a new section was added to the Internal Revenue Code. It was Section 7701, Parent O. And the purpose of this is to codify the doctrine of economic substance. Well, you said, okay, Mike, you've said this a lot. What is this doctrine? Well, the doctrine is basically this. Any kind of activity that you have going on needs to have some economic purpose other than simply reducing federal taxes. And so let me share with you the screen right now where the law is quoted. Hang on while I find the right spot. There we go. So you're looking at the screen now that shows this article. It's from the Journal of Tax Practice and Procedure. Fascinating reading if you're a tax guy, but probably for you, not so much. But here's the part I'm talking about. The section is entitled Clarification of Economic Substance Doctrine. And it goes on to point out that the economic substance doctrine is satisfied if this two-pronged test can be met. First test is that if the activity changes in a meaningful way apart from federal income tax effects the taxpayer's economic position. In other words, it makes a change in the taxpayer's economic position. The second prong is that the taxpayer has a substantial purpose apart from federal income tax effects for entering into the transaction. In other words, there's a reason to do this transaction apart from just saving tax money. So I want to focus on that. The article goes on and talks about some other things about future value of money and things like that. And if you're working on your business from a CFO standpoint, that kind of financial analysis is probably important. But for the purposes that I'm talking here, it really isn't. I want you to zero in on those two sentences, the one here that it changes in a meaningful way and that the taxpayer has substantial purpose. Because I want you to recall the statements we made yesterday that in order for what you do to be a business, you have to have the intent to make a profit. That's just like the substantial purpose that we're talking about here. And you also notice that it talks about it changes in a meaningful way. It does not say it changes it in a meaningful way to increase it. So that leaves that same opening there, that in order for you to have a business, it does not require that you make a profit, but that you have the serious intent to continue to make a profit. Why would I bring that up today? Well, for this reason. When I encourage people to reorganize their companies as S corporations, I do so to save them taxes. But I want you to understand, and this is made very clear in the book when you get your hands on a copy in another month or so. It's made very clear in the book that there are other reasons for organizing your company as an S corp. And while those reasons, or while they may allow you to save money on taxes, there are strong reasons why you want to do it otherwise. And I'm just trying to let you know that if you're doing something to save tax money, what you're doing needs to have an actual economic impact. It has to have to do with the operation of your business, with the flow of your business, with the things that you do to make your business stronger and better. That's the whole purpose of being in business. We just talked about that. And now we're talking about the fact that there are ways that you can save money, but it does require that the ways you save money have an economic purpose. Let me expand on that just a little bit in a general standpoint. We have just gone through a frenzy of advertising to get small businesses like yours to capture their earned employee retention credit as a refund by filing amended 941s for the employees you had during the pandemic. And there were very specific requirements that you had to meet in order to be able to do that. When the CARES Act, and I think there was another one of the pandemic acts that affected this activity, when these things happened, this was part of the law. It's just that there was so much happening, many people did not pay any attention to it. And so then the law at the end of the pandemic was added to the fact that you could still apply for these credits by amending these reports that would have already been filed. But there was a frenzy of people trying to tell you the money that they could save you if you would simply file for that. And in good order, people would file those forms and they would get a nice fat check from the government based upon that response. Whatever you say about the IRS, in general, not in every case, but in general, the IRS refunds the money first and verifies it later. Well, that's what happened with these ERC credits. Well, such a frenzy was, and frenzy is the word for it. I would get 4 or 5 emails a day from various people that were telling me how much money I could save, or if they were promoting to tax preparers, how much money I could save my clients. Believe me, I watched this very closely, and none of my clients qualified for substantial savings because of the way they conducted their businesses during the pandemic. They operated their businesses smartly. They did things like they should have done. They didn't excessively spend money. They controlled what their costs were. They controlled how often they were open. They weren't in a position, like many businesses were, to continue to pay employees for not working. Or, more importantly, they did so well during the pandemic that instead of having a reduction in income, they had an increase in income, which also made them ineligible. I wasn't ignoring it. It's just that I could tell that none of them qualified. And so we made no attempt to do that. But I do know that there were thousands that did. The IRS recognized that many of those people that were doing that were doing so fraudulently. They were either doing it because they didn't understand the requirements, or they were doing it because they were whipped up into a buying frenzy by one of these service providers. Well, the consequence is that I think it was a week ago, maybe 2 weeks ago, the IRS put a moratorium on processing amended 941s from that period so that they could catch up, because there were so many of them. They were behind, but more importantly, they were finding out that most of the amended returns were fraudulent. They weren't right. They didn't count. And people were now going to be compelled to pay the money back that they got as a refund, plus which, because they were paying it back, it was as if they hadn't paid their taxes. And now there were penalties for fraudulent filings, plus interest on money that they should have paid but then got back, which has the consequence of making it as though they didn't pay it. It's a mess. For those few people that legitimately were applying for that, I had a client that that finally came to me because of a referral. That came to me because of a referral from a bookkeeping service that I am partners with. We filed 941s when it was shown that she was entitled to one of these credits. But I'm not sure whether it will go through, because I'm not sure where it was with regard to when the moratorium was imposed. Although those that were stopped, they intend to resume processing them after the first of the year. My point is this: the idea of economic substance requires that you do the things you need to do in accordance with the practices that are prescribed by law. I've said it before, and it really boils down to this: business owners need to do what business owners do. And one of the things that business owners need to do is to comply with the law. One of the things that business owners need to do is to be sure that they're dotting their I's and crossing their T's, to make sure that they're complying, so that if anybody comes back to them and says they've done something wrong, they have the documentation to prove it. Part of that documentation is to be able to show that you have economic activity going on besides manipulating money to save on taxes. There's nothing wrong with saving on taxes, I'll say again, but you have to do it in conjunction with an economic process, with something going on that increases the value of the economic system, or in some way affects it with the intent of increasing that value. Look, I understand that this is, I told you at the beginning that this was really geeky tax stuff, but I wanted you to be aware of the fact that at least when I advise you on how to do things, and if we work together so that you are in a position to take that advice and act upon it, that I will always do that with your total picture in mind. And I say that to you because of this. There are a lot of bad actors in the tax practice world. They are people who will do things that are so flagrantly fraudulent that it boggles my mind that they get away with it. But I know they're out there. And look, who wouldn't like to actually receive and get to keep the boon of several $1,000s in essentially free money? I mean, that's something that anybody would like to have. But always remember the old rule that if it looks like it's too good to be true, it probably is. And that certainly was the case with these ERC credits, particularly once the advertising campaigns had convinced people that even though they weren't eligible, that they really were. So if you come to me and we talk about switching your company into an S Corp, be assured that we will do it because I see advantages to you over and above the tax realm, even though that's the source of my concern with doing it for you. So that's it for today. Like I said, I'll stop geeking you out. Tomorrow I'll stand up again because we're going to talk about marketing to customers. But please think about this issue. Think about your business. Make sure that you understand what it means to be in business. And until tomorrow, have a good afternoon.